to have a chat about how to raise money. So as I said, I gave this talk for the first time over 10 years ago, and what I talk about and what I go through has not changed in that entire period. And that's because my view, whereas the trends or the valuations or things may change over time, I think the underlying art and science of how you actually raise money sort of like stays the same. And so we're going to try and assume in this room that nobody knows anything. And that's why I wanted everyone to be here at the beginning, because if you're hearing me talk about something and you don't understand what I'm talking about after a few minutes, you're probably in the same situation as half of the room. And like, that's the sort of point that you raise your hand and sort of like ask a question, okay? This is definitely interactive. I encourage you to ask questions. That helps me clarify and make sure that people are actually understanding what I'm sort of saying, right? But we're going to assume, sort of like no knowledge and that you don't know anything at the beginning, but we will layer on it and be pretty advanced by the end. Guys, there are a few spare seats. There's one here. You're welcome to spread out a little bit. I see at least 4, 5, 6, 7, 8, 9, 10 sort of empty seats still. So come into these gaps. Thank you for coming a little bit closer. Now, is that a question already? Oh, no, you're just exactly pointing out the chairs. I love it, right? And so look, before we immediately kind of like kick off, I want to start with a bunch of kind of like caveats, right? So, how to raise money. First thing is like how to raise money for what? Okay, and like this whole whole session is going to be talking about raising money for a very particular type of thing, which is not a very normal thing, right? And that's a company, a startup that wants to go and win a multi-billion-dollar global opportunity where, because there is this opportunity, it will be competitive. And even if you are profitable on day one and making millions of dollars of revenue, you are still going to raise capital because it's a competitive opportunity and you need that capital to go and launch and win more markets in this sort of like global opportunity, right? So it's a very particular type of company where you're typically doing something new that's not been done before. That's why the opportunity exists, and that you need to raise capital to go and capture that opportunity before someone else does, right? Now, that is not 99.8% of companies that get started in the world, and the vast majority of what I talk about is completely irrelevant for all those other ones, right? So very narrow in that regard. Now, when it comes to giving advice and doing this stuff, right, like, anything I say to you today, I try and follow myself. I at least promise you that. Right? Not only do I believe it to be true, but I follow my own advice. That doesn't mean I'm very good at following my own advice. Some of these things are a lot easier to say than they are to actually do, but that doesn't mean that it's wrong. And that goes for the advice that you receive from anyone, right? The person giving you that advice may not be capable of even following their own advice, but it doesn't mean that what they're saying is not true. I'm optimistic what I'm telling you is true, but I acknowledge that it's extremely hard to do it, and I'm not even saying that I'm able to do it as well as I would like myself, kind of like the whole time, right? So there's some sort of basic sort of like things. I might think of some other caveats that I'll bring up as we kind of like go through. I'm going to try and write more clearly on the board than I do normally, given we're recording the board as well. Yeah, let's see how we go. Okay, so what I want to kick off by doing is that for all of these companies that we're building, we're trying to raise money for, there is a goal. What would you say for this type of company the goal is?
Become a unicorn and build?
I think that's definitely fair. And what's that indicative of, being a unicorn or becoming worth $10 billion? Again?
Change the world.
Change the world, definitely not that. Yeah, like definitely not that. Yeah. It's much closer to this, right? It's about delivering returns, right? You're raising money and you're trying to deliver returns for that money, right? And actually, how do you deliver those returns? Like, what is the goal of this journey that you're on? It's to have some sort of exit moment that happens, right? And so what's the actual goal? What are types of exits that you can have? IPO. So this is the actual opportunity, or rather the actual goal, right, is IPO. And this is sort of like at least the end of your private journey and the beginning of your public journey, and not all liquidity comes on day one. But it's what you're aiming for. Now, what are other types of exit? Acquisitions, M&A type stuff, right? Now, why is that not the goal? Or at least like, why is that a secondary goal versus an IPO? Because if you're, if basically your only option is IPOing, it's because you've got big enough that no one can afford to buy you, right? If you're M&Aing and you're selling, it's basically typically because you didn't capture as much of the opportunities as you could have, or it's a smaller company and there's this bigger beast that is able to buy you, right? So what you're trying to do is build a company which is capable of IPOing. Now, loads of caveats, stuff changes. Companies are capable of staying private for longer over time. The private markets are much deeper than they used to be, but still, right? Like the liquidity typically comes from this sort of like IPO. So that's the end of the journey, or at least it's the theoretical end of the journey, please.
So it's IPO because other exits are basically failure, so you have to set yourself IPO?
Yeah, I think that would be like a really, really strong way of putting it. But yes, you could have done more.
I'm a little confused because at the outset, you said this is the only goal to raise money, but companies raise money all the time, not just to IPO, to grow.
I'm saying that if you're raising money at the other end of this journey, right, which is where we're going right now, okay? This is you in a room on your own. No one cares. You have no money in the bank. You have no product. You have nothing, right? That's the start. That's where we begin this journey, right? And I guess for the type of company that we're going to talk about, the goal is to take you from a single individual here to IPO.
Yeah.
Okay?
There is also some fundraising and go along the way, which I also
Yeah, that's what we're going to talk about for the next 2 hours, right? Yeah, so that's the segue, right? Like that's like the whole point, right? It's like we're working out where we're going so we can then understand the point of the steps that we're taking along the way, okay? It's worth noting that this is the first session of 4 sessions that I give regularly, so we're going to get as far as we can, but there's going to be a lot that's sort of like left on the table, right? So what I want to do first, right, is exactly this, right? Between these 2 points is to track, I guess, like the players and some labels and some names and start to add on data to this timeline as we go through the rest of this session, right? So when you're right at the beginning here and you're on your own and you're going to start to raise money, what might we call the first fundraise that you did?
Pre-seed.
Pre-seed, okay. What? Angel? Friends and family, right? At the beginning, only you are stupid enough to give yourself money, right? The next step is friends and family, right? That you can emotionally trick into thinking you're working on something that's valuable, but are probably not, right? So friends and family, right? And these are very like non-professional investors. Like this is, all over the place. Now, someone over here said angels, right? This again, I put as a round ahead of a pre-seed sort of like round. And this is going to happen, but these are actually typically more professional investors, right? And those guys are going to come in sort of like next, kind of like here. Then after angel, right, but what would typically, or what often happens before there's a pre-seed?
Bridge?
Not, maybe, unlikely. It does. Bridges happen between every single round, but we'll come to bridges specifically in a minute.
Can you go to the banks at this stage?
No one's going to fund you from a bank, not for this type of company, not at this stage, no.
Bootstrapping,
Bootstrapping,
building the MVP. Building the MVP.
yeah, for sure, these things need to happen, but accelerators tend to happen at this point. They don't happen after pre-seed rounds. The number one function of an accelerator is actually to get you a pre-seed round, to get you more money in your pre-seed at a higher valuation, okay? So actually what accelerators are doing is literally trying to take rough diamonds, polish them over 3 months, and put you on stage to raise capital. And that round that you're raising after accelerators is typically like your pre-seed round. There's obviously exceptions, and I think like that's the other thing I like to say as a caveat at the beginning, okay? Is that one of the things that's very contradictory about this whole thing I'm about to do in the next 2 hours is that I'm going to try and give you patterns and rules and processes and ways of doing this, right? But what we have to remember when it comes to the game of venture, we're literally in the business of doing things that have never been done before. We're in the business of creating exceptions. And so I'm about to go and tell you a whole bunch of rules, but what I would say is that unless you really know better, you shouldn't be an exception to the rules that we're about to go through right now. The thing you're going to be innovating on is like not your fundraising approach, right? It's going to be the thing in the market, right? But literally there are 1,000 different ways to cut a cookie, and we're going to look at that sort of like medium sort of ground across it, right? So what was I saying here? I was saying accelerators, okay, here. That then leads into a pre-seed. What comes after a pre-seed? Yeah, it's seed, exactly. What would come after a seed? Right, this is where this gentleman here, I want to bring back the bridge, right? So what's a bridge round?
It's like an early seed, essentially. If you're pre-seed or let's say seed before A, it's essentially a lower valuation than you get on the seed A, but it's the ability to kind of scale or reach to a certain point in your product or what it might be in order to then be able to close an A.
I think that's fair, right? If we were being spicy, like at the beginning about like, M&A versus IPO, a bridge is failure, right? It's that you were capitalized in a previous round to achieve something, you didn't get there, and you need bridging to get the rest of the way, okay? Now, the reason I put it here, as opposed to in between any other round, which they can happen at any other place, is because the bridge between what comes after seed is Series A. This is the hardest chasm to cross. It's the place where most people sort of fail. The type of business you need to be running between seed and Series A is ginormously different, and it very, very often takes more capital and time to get there. And so bridges can happen between anything, but this is the place that they most normally go, right? Say, after Series A. Yeah, after B, C, okay, we don't need rocket ships, right? Okay, fine. So this is the landscape. Now, one of the things that we're actually doing in this session, and part of the reason that we start with just like aligning out a timeline and putting labels on this stuff, is like these words really matter, right? The words that I'm using to describe things are the words that everyone uses to describe them. If you use different words to describe them, you look stupid. And I'm immediately going, oh, he doesn't know what he's doing. And then you're going to be much less likely to be invested in, right? Like this is a game, right? Everybody at this end of the game, or rather everyone at this end of the game, friends and family aside, right? Everyone at this part of the game understands the game that is being played and understands what a founder and a company has to do at each of these stages to get to the outcome. If you are not able to communicate what happens at this end of the process, you're going to have a harder time at this end of the process raising that capital, right? Because the only reason someone's giving you money here is because they're hoping you're going to go here and get money here and get money here and go and all the way, right? And I'm saying that like the goal is never like profitability. You have incredible companies that everyone's heard of, right? Like Cursor and Lovable that have generated more ARR in shorter periods of time than ever before and have been able to be profitable very quickly. They're still raising ginormous amounts of capital because the opportunity is mammoth. And again, the expectations of people playing this game is that you're going to do that as well, okay? So we're creating a common language, and the things that we're doing and the words that we're using are important for you to be able to use as well in the conversations that you're sort of like having with people, right? As they are signals that you understand the game, okay? So that part out there, right? Now, another caveat at this point. I am extremely biased to top of global market sort of like numbers and experience, right? Like I have not done any investing in Malaysia. I have not done any investing in mainland China, right? I am much more accustomed to what happens in the better side of the US and the European market. So that means when it comes to things like how much do you raise at each of these stages, or what valuation do you raise at that stage, I'm biased to a certain type of company, okay? And so what we're going to cover in this next sort of section is what you can sort of consider is almost like the high waterline of like, if you're doing well in those markets, what the numbers sort of look like, right? But actually in other markets and other places, everything is going to sort of be like less than that, if that makes sense, okay? Because what I want to run through next is sort of like to give an indication of like what sort of like people first sort of like participate in each of these, and then what amounts of money are typically changing hands at each of these sort of like stages, okay? So in the beginning, this sort of phase here, fairly obvious, right? These are individuals. Who participates in an accelerator? This is an accelerator. This is the old one, right? It's typically the accelerator itself, but the accelerator will have other people's money. It will have raised capital and be deploying from what are called limited partners. We're going to come into venture capitalists a little bit later because it's important to understand their game. Please. Yeah, maybe, but I mean, like you're talking like of the capital that matters, a really, really small fraction globally, There could be other players for sure. You can like this stage here is where you also get things like grants and this sort of stuff, right? To maybe kind of like get going, but it's typically a small proportion of the capital that's going, particularly to the more professional or like the better run companies, etc.
Plus, oftentimes, governments and other vendors are doing through accelerators because they have a professional knowledge to act as filters, right?
Private equity?
Definitely not private equity.
Big name
No,
angels.
that's all right. We're not. That's all right. There's no. So again, so accelerators again, it's just they're sort of their own individual entities. They'd have raised capital from LPs. Those LPs are very often people that are acting further down the funnel. And then at pre-seed, okay, which is sort of like your first, what I would say, sort of like real round that will kind of like happen. Who's participating in the pre-seed round?
VCs, angels.
Agree.
Angels.
Right? And so basically everything from here to pretty much like Series C, the vast majority of this capital that's deployed, and we're talking like 90% into the types of companies globally that we're talking about, it's coming from specialized firms which just invest in this particular company, right? Venture capital firms, right? Like there are like exceptions, there are governments participating, there are family offices that are maybe getting involved, but it's like all a tiny sliver of capital versus venture capital, right? As you start to get out into sort of like these phases here towards IPO, you then have sort of like more sophisticated, maybe not quite private equity, but like private investment firms that want to get involved. So if you're going to IPO, like all of the investment banks will have tried to invest in you before you get to that stage, right? In the rounds before that. Family offices are more active here, just broader, bigger private equity firms, not pension necessarily, but institutions will get involved at this sort of stage here, right? But at this point, it's because you've built an established bigger business, you've got out of this real startup phase and they're funding something with much, much less risk. Please.
What about a SPAC?
Yeah, that's sort of very unrelated. So SPACs would be a vehicle that you use because basically going public is like very expensive and it takes very long. So like typically the process of going to IPO, you would start preparing 2 years in advance of kind of like going to IPO. So it takes you 2 years and it costs a load of money and like you might get rejected by the regulators, by the exchange. And so instead SPACs are like vehicles. They're like off-the-shelf companies, except the companies happen to be public companies, right? And so you can buy them for whatever price, and then you can like capitalize them to whatever you want, and you can use them to buy private companies here and sort of like accelerate the IPO process, right? But a little bit unconnected to what we're talking about here. Okay, so now what do round sizes look like for this stuff then? So for you and yourself, let's just assume this is like 0. And it's yourself. How about your friends and family? How much money do you steal from them? Yeah, it's like how rich are your parents, right? Like you got some biases immediately out there. Like you can see who's got the richest parents in the room. But like this is like, again, I said, like, look, this could even be like a few $1,000s, right? To help you do your first like software subscriptions. 2, if you're lucky and you're like Bill Gates, maybe it's like $500,000 from your parents to kick off Microsoft, right? So like, but this is typically, I think anything sub 50K, I think is like, and like, again, maybe you're lucky and you've got better parents, right? How about like an angel round? Like how big is an angel round? 250 to, I think that's sort of like fair. I'd say like anything up from this, right? Let's just say like 100 to, I think like sweet spot might be like 250 kind of like K here for like a smaller angel round. Now, interesting when it comes to sort of like angels, right? Like what size ticket does an angel investor typically write?
50 to 100, depends on the angel.
10.
Yeah, like the median angel in the world is going to try to write you a ticket less than $10,000, and you're probably going to reject them. And then the median ticket that you take is going to be $10,000. The reason you reject a ticket less than $10,000 is because actually the legal cost of managing an investor that gives you money here at Angel until IPO is far more than $10,000. The administrative burden is a pain in the ass, right? And that's even like outside of like, if you have to coordinate 50 angels to sign paperwork for you to do your round here, and 5 of them are in Saint-Tropez, someone's on a boat, like this becomes like very, very difficult, right? So this is part of why, it's still worth you taking a $10,000 ticket because it's basically bringing cash from the future to now. Like, you don't have to incur those expenses for a while. But yes, so median ticket is more likely to be 10,000. And like even the super angels, like the billionaire founders that like purely deploy into this stuff, like might write like $1 million tickets like themselves, right? But the number of people doing this is tiny. Even the number of people that are writing $100,000 tickets at Angel is tiny, you know? I don't think I'm on camera, but I don't know, say I might cut this bit out, like I'll just like, you know, right? So cut that one out. Question?
What valuations, what percentages are we talking about here?
Yeah, we'll get to that in a minute. That's not quite in the flow of where we are, but we will come back to that. So anyway, so I'm just giving you a reference point. Well, like, look, if the average person, the median investor angel is actually giving you $10,000, right? Maybe you're able to get a super angel. Anyone running 100K is basically a super angel, right? Like, again, like you getting a 250K ticket is like you coordinating like 15, 20 angel investors, right? And like that happens, but again, like these rounds are typically smaller because angels are typically writing smaller tickets than you maybe think, right? Again, if like, yeah, that's sort of it is, right? Again, there's always like, all of these things have a much higher sort of like a range around the sort of like on the normal distribution that we're going to talk about, okay? Accelerators, how much does accelerators invest?
500K to 1 million.
100K for 10%.
So what does YC invest, which is pretty,
500.
500. How do they split that down?
125.
Exactly. They give you 125K for like 6%, is it? Yeah. And then they give 375K on a MFN, which is a most favored name. It's basically like the second half of this converts at the price of the next round, right? So you take more money, you get it on day one, 125 for 6%, and then excess will come in at the next round, hopefully at a much higher valuation than 6%. They'll probably get on average like 1.5 to 2% for this amount of money, kind of like here, right? This is again like top watermark, like Speedrun A16Z, maybe like 500K, HF0 in some rights 1 million. They probably like to give the best investment terms in the world, like $1 million uncapped at kind of like at the accelerator, but they still expect to get like 5% for that kind of like overall. That's what they appear to have been converting kind of like previously. So that sort of amount. What was your question?
Do these numbers change if you're raising for a fund? Because obviously a fund, you're deploying $10,000, $15,000 checks yourself.
A fund, I mean, this is a fund is completely different to any of this. Yeah, I'd say a fund is completely different. Yeah, I'm afraid. So okay, so that's exciting. And then, so how much is what's your pre-seed? And just to be actually on this in here, like this is like again top of the watermark, like much more normal than was the first answer, right? Like $100,000 or something like this, right? And getting sort of 6%-ish for that, right? That would be like a much more normal experience for someone going through an accelerator. But yeah, YC does a great job. A16Z does 500K, HF0 1 million, but that's the best in the world by a significant margin. Okay. Pre-seed, how much do you raise at a pre-seed?
1 to 2.
Yeah, fair. I think if you're lucky, you can push that a little bit higher. When the market was a bit fluffier, 22, 23, I think like the average YC, the medium YC company raised about 4 million at an $18 million valuation on their demo day. I think right now there's not recent data, but last year it was down on that. Maybe it was only 3 million on a 12 mil kind of like valuation. We'll come into what those numbers mean a little bit more in a second. But like, look, I'd say anything, right? Like again, 500K to like, 4 mil at the highest is sort of like where you are for kind of like a pre-seed, right? How about a seed round? Yeah. I'd say that like anything from like 2 to 10 mil. Your bridge, what's a bridge round?
Depends what you need, 500K, a million, usually 500 to a million, depending on what stage.
So like it's basically, I'd say it's normally like half of your last round, 50% of your last round, maybe a little bit more if you're lucky and you can get away with it. Why 50%? Because basically, again, you were given money and you've like accumulated a burn rate, which is the amount of money that you lose like every single month, right? And then you've managed to get a set of investors to give you longer on your sort of like current trajectory to try and achieve the things that you didn't quite achieve already, right? So basically it's typically allowing you to have another 9, 12, whatever, 15 months of sort of like runway. And so that's typically going to be about half the size of the last round, right?
So this
What
bridge
do you
round,
like? Oh, sorry.
so this bridge round is like only to meet the targets to raise Series A, or what's the purpose like? If there-
I mean, let's come to this in a second. Of like, what's the what are you trying to do with every round, right? I guess is the question, right? But we'll come back. Don't worry. If I don't answer that, we'll come back.
So the bridge is 50% of the previous raise. Would it be like also 50% of the valuation? So you're
No, you typically, no. I mean, it's always a negotiation, right? But like typically it would probably happen at the price of the last round. If you've got a good argument for a markup is like an increase in valuation, then maybe you can get to do that. Bridges happen from existing investors, right? Bridges tend not to happen from external investors. It's typically investors putting good money after bad. If you know the expression. That's unfair again, right? But like, it's typically existing investors. They're just backing their own bags, right? And we'll come into that a little bit later as well. Okay, Series A, again, things just like, anything from 5 mil to whatever you want, 25 mil, and things just go up, right? From that point. Okay, so let's ask a question that answers some of the things that have been answered there, okay? How much money should you raise? So I actually like that answer. I am sympathetic to that answer. And I think you should. You are, as a founder, it's probably, the challenge is that people raise too much money and then they're undisciplined with it. Suddenly you can afford to do 10 things, not one. And that most people are not able to be disciplined to just do what they want, right? But if you can, then the more money you've got is typically better. You hear loads of VCs talking about how you shouldn't raise too much, you shouldn't raise at such a high valuation. Well, again, you don't want to get over diluted, that's for sure. And you've got to be cautious about that because again, you got to think that for you from here to get to here, you're probably going to raise 10 rounds of finance, right? And so if you're getting an additional 10% dilution at every single round, that's a huge difference at the end over here when it comes to your sort of outcome. But how much do you raise? Okay, so I think when we talk normally through most of the rest of the session, just assume I'm talking about more like a seed round, okay? For a seed round, how much money do you raise for your seed? I think that's a good question. And how much do you need? But how much do you need?
Enough to get to the next round.
Enough to get to the next round, right? That is exactly the question. So again, back to some of our early points. Again, understanding the game. For you to successfully raise your seed, you need to understand what you need to achieve to be able to raise not your seed, but your Series A, right? Because you need to be able to basically work out a plan which gives you a number that you need to raise at your seed to be able to get and achieve what you need to at your Series A, right? So for you to succeed at every single one of these rounds, right, you're going to have to achieve certain things, right? Right at the beginning, maybe you don't even need a product, right? Not to convince yourself to give up your job, right? Or for your family. But here, you're definitely going to have a product, and actually you're going to have revenue. You're going to have growth. You're going to have these KPIs. And why these labels are so important as well is because an investor that does seed investing, right, just sees hundreds of deals constantly and has an extremely good idea at what is top of market in terms of performance on those KPIs for a seed company. So you can use this to do little tricks. It's if you are a underperforming, you've raised the pre-seed and you're underperforming, you're trying to raise a seed and it's oh Christ, we're under market, right? Well, maybe you can just label the round that you did previously as a bit of a friends and family or an angel round from people that you kind of knew, and actually you're in the market for a pre-seed. Because as soon as you say the word pre-seed, expectations change completely as what you've meant to have achieved. Okay? And it's really, there are very different things that you're meant to have achieved at pre-seed, seed, and Series A, right? We'll come to this a little bit later as well. Go.
What is the time frame that you're, it's good from a VC perspective between, let's say, seed and Series A? If it takes 4 years, it's also a different mindset of what you accomplish in that time compared to.
Yeah, I'd say I feel everything is accelerating. Everything is accelerating. The expectations of cost of production goes down, is that you're able to achieve more for every single dollar that you get given. And just generally teams and AI is helping basically everyone move faster, right? And the markets are just generally more liquid, a more global kind of market, things happen faster and faster. So I'd say that probably 10 years ago, rule of thumb was okay, you get funded to last 18 months and you want to have increased valuation 3x in those 18 months, right? The next round. That these days it's more it can be a lot faster. I think look, when you're talking to investors and you're raising a seed, I would love, and again, this is before you've raised your seed, right? So you're post pre-seed and you're having these conversations with investors about your seed. A big tactic that I recommend is you projecting a trajectory of your Series A happening in 6 to 9 months after closing that seed round, right? Now, that's not what the median company is going to do, right? It's going to take much longer. It's going to take a year, 18 months, maybe a little bit longer, right? Depending, and maybe you're going to have to get bridge because you don't get to your Series A. But they want to invest in the next Cursor, the next Lovable, right? And those guys fucking rock it, right? And they're actually taking these further rounds much, much faster, right? And so if you're onto something and things are moving, particularly kind of like out this side, like, rounds can happen quite quickly, right? Because you can grow very fast if you build companies capable of it, okay? Let's keep jumping through this, okay? So we did actually get to the answer here, right? We said like the amount of money you need. Okay, well, how much do you need? You need the amount of money at a given round that allows you to get to the next round. So basically, how much you raise is the dollar cost of your milestones for the next round. Now, you achieve your milestones and then you run out of money the next day. So this is not quite as simple as that, right? You need to give yourself time to then actually raise and to not immediately run out of money, right? So I'd say sort of like here, like 6 months of runway additionally on that, and then like give yourself 20% padding just for all the things that you have underestimated, okay? Now, I would suggest that this is the minimum amount of money that you would raise at any of these stages, right? You sit there, you work out a plan that you believe in, it points out, it pushes out a number, and it's like, that's what you should be trying to raise. And if you get anything less, maybe you need to change the plan. This is the minimum. Now, back to the comment over here, right? Like, I do actually encourage you to raise more than the minimum, even at a higher dilution. Particularly in these earlier stages where risk is still really high for you as a founder, right? That you are completely wrong, right? And if you have enough capital, capital will give you time, and it will give you time to try and like fix and solve some of these problems, okay? So this is the minimum, okay, of like how much money do you raise, okay? And it's gonna have to be sensible, right? Because if you think that you're a seed and then you're asking for 25 mil, like it happens. There are companies that have raised hundreds of millions of dollars at seed, but they are pretty much 1 in a million, right? And unless you're doing something which is 1 in a million, you're going to put it in front of a VC's desk and they're not even going to open the deck, right? Or they're just going to laugh and push it to the side, right? There's all of these figures that we're covering here are known by everyone playing this game. And if you're outside of these normal distributions that we're talking about, like it's just red flags immediately, okay? And like people aren't looking for reasons to say yes, right? They're like looking for any excuse to say no, yeah? At every stage of all of these processes, yeah? So you have to give them 0 reasons for that. So you've got to make sure that it's appropriate for what you're doing. And if it's not appropriate, you're probably going to have to adjust your plan, yeah?
Wait, so what do you mean by the dollar sign M in the equation?
The dollar sign to achieve your milestones. Yeah. Yeah, plus 6. Oh, I know I've used it twice. Yeah. Just to make it really convincing. These M's obviously refer to different things. It's not a real formula. No, thank you. That's it, right? Okay, so now the next question then is valuation. So let's say that you are raising 5 million at your seed round. What valuation do you raise at?
Depends on industry. 25 million.
20 to 30.
Total addressable market is one metric you would involve to make your case.
Maybe, yeah, but like just what numbers? Like how are we gonna what's the literal?
My rule of thumb is in each round you dilute 20%. If you're killing it, 15. If
Right.
you're targeting 25.
Right there, that is like do you want to come up? Like this is that's like great, right? So the key point here is that your valuation is a function of the money that you are raising. Yeah? So like if you're diluting 20% on average, if you're raising 1 million, your valuation is going to be a lot lower than if you're raising 10 million. And it really does work like that. Because everyone here is trying to take they have target ownerships and they're sort of expecting to play this game where you are diluting, say 20% in a seed round. And so that's the expectation. So if you're raising towards the end, the higher end of the bound for seed, your valuation is going to be higher at seed round, okay? But this is literally true, right? So it's basically it's a function of the money raised. So it's money times 5 would give you a valuation on. We need to go into some detail here. Who knows the difference between pre and post money valuations? Please.
So the value of the company before reinvestment and after reinvestment. So it just like basically the market, the cap table is different.
Yeah, it's basically this, right? So if we say that your pre-money valuation is 20 million, and we said that you're raising 5 million, like it's not rocket science, your post-money would be 25 million, okay? Now, the nuance here is that if someone is just using the word valuation in a conversation, if you are not using valuation to refer to the same thing, that can have big impact in valuation, right? Because think about it. If you're raising 5 million at a 20 mil valuation, okay, if that 20 mil is the pre-money, then your post-money valuation is going to be 25 million. And 5 million on 25 is a 20% dilution, right? If instead of it being a pre-money, actually the person is going a 20 million post-money valuation, your pre-money would be 15 million, and then your dilution would actually be 25%, right? And so that's like, 25% extra dilution, 20 versus 25% dilution. And again, if you're doing that at every round, that's a disaster, okay? So you've got to be cautious here about like the terminologies that you're kind of like using. When I'm talking and I said like, for example, I said like 3 on 12 for like that YC benchmark, right? Or 4 on 18. What I'm referring to is 4 or 3 is the amount of money in millions that they're raising. And like 12 is the pre-money, right? So I'm saying like 3 on 12, again, that's a 20% dilution, right? And so yes, back to that. Okay, so it's a function of the amount of money that you're raising. And if you want to work out your post-money valuation times the amount that you're raising, say 5 mil by 5, and you'll have a post-money, okay? Now that is like at seed round if you're like doing pretty kind of good, right? And as the gentleman alluded, if you're doing better than good and you're more top of market, then actually the multiple might increase. You might be able to get it to 6. You're rarely going to get it to 7. Okay, that's again like diluting 15% or something, right? And if you're not performing top of market, like it might be a little bit more aggressive. Maybe it's only a 4. You don't want to get anywhere near 3. That's terrifying at that point, But this is a real rule of thumb. And again, like everyone knows this. So it's like if you're like, okay, how much money do I raise? We've given you an answer. What valuation should you expect to raise that at? We've given you an answer, right? Now, I'd say that the divergence is from seed. So actually like pre-seeds or these accelerators like we talked about, right? Like ownership kind of like on average tends to be less that's taken, okay? So it's like, you can get away, it's much more normal, for example, to just take like 1 mil in a pre-seed at like a 9, like 1 at 9. That's only a 10% dilution, okay, right? But it's also very normal to take 2 at 8, right? And so it's like, it depends. And again, when you get higher up here, it's very unlikely that like a seed or a D round or something is like there's 20% dilute. It's much more likely it's like 5% or 10% dilution that's happening in these kind of later stage kind of like rounds as well, okay? So that's the valuation that you raise it at. That's how much you're going to raise. This is the difference between pre and post money kind of like valuations. Any more questions on that section?
So, for example, if I want to invest my own money of say 500k to 1 million into my own startup,
Yes.
so can I directly go for pre-seed or seed instead of and skip all of the previous rounds to save the dilution, or should I start from the beginning, friends and family? Even though I'm capable to invest in my own startup for 500k to 1 million.
I mean, if it's just you can do whatever you like, right? You can label it a Series F round and invest yourself at 100 million pre-money, right? But the reality of this, right, is that like these refer to startups at a particular stage that exhibit similar characteristics and achievements, right? And this is what I'm saying is like if you're actually a seed company and you've not achieved what you're like the cohort and what your competitors, right? Every round is competitive. Again, like we'll look at partners don't write as many deals as you think. And there's 100 others that they could do at any given point. So you have to be better than everyone else, for them to bother to do you. And so like you don't like have a choice. Like it's not like you just go like, oh, there it is, right? But if you're funding your own round, you can do whatever you like. If you're trying to have other professional investors be involved in your round, then like it's going to have to depend on your company and what makes sense at that point, right?
Yeah, raising is not fun. You raise because you need to raise. If you don't need to raise, you don't need to do it because you have the money or your father gave you the money. It's not
Oh no, this is like a lot of pain, that's for sure. Don't worry about that. Yeah, it's fine.
Wait, because otherwise you lose in the market.
Yes. Yes. Natalia, did you have one?
Yeah, I want to ask, what's a healthy dilution rate to sort of have throughout these stages? And
So like, yeah.
when you bring on new people.
So I think that if you get to like Series A and the founders don't control like a majority of the company, like 50% plus of the company, that's pretty much a red flag that you've been like over diluted through this phase, kind of like here, right? And you know, I've been in some really interesting situations, right? Like you're running your company at seed and you're desperate to get a Series A in the bank, right? You're running out of money, and they're sat there going, "Oh, worried that you don't quite have enough of this company." You know, I'm like, just give me the fucking money. It's gonna be dead tomorrow, right? But it is actually a genuine problem, and actually, you know, not all founders are equal, and CEOs are more important than other founders, and very often at Series A and onwards. CEOs or founders will get recapitalized. They'll basically be given extra shares to ensure that they are seen to be incentivized and like the majority shareholder on the company, right? So yeah, if you've diluted more than 50% at this point, that's like kind of like that's not great, right? Like you're again like this is where it's tough. Like a lot of people over dilute in this like angel friends and family sort of stage down here to try and get over here. Really, you want to like skip this stuff, you know, just join Network School, pay $1,500 a month, you know, eat rice, don't leave the building, right? Like spend $0, right? And try and get yourself all the way to like a pre-seed without diluting at all, right? You know, that's it. Like accelerators don't help you with fucking anything other than getting your pre-seed, right? So like just this is like, so, you know, try and dilute nothing here. If you get into YC, sure, the club is definitely not as good as it used to be, but go for it. And then here, pre-seed again, like you're going to dilute a minimum 10%, maybe 20%, and your seed again, sort of like 20%. If you've done a bridge as well, again, you're going to be struggling with this 50% mark as well, right? So you've got to perform quite well to get to that point, right? Of kind of like having at least 50% ownership in the firm for like your Series A. Yeah, yeah, go for it, please.
How about super voting stock? Do you need to be exceptional to do that?
Yes, you do need to be exceptional to do that. Yes, anything which is not normal, you need to be exceptional to do. Most people are not going to manage to get away with super voting kind of stock. I'm going to try and get away with super voting stock. I'm going to try and get away with only selling non-voting stock. We'll see how well that goes. Yeah, we will see. Okay, let's keep motoring on. I think what we're going to do next is paint a picture of we're going to just talk a little bit about venture capital funds because it will answer some questions that came up kind of like there, right? And so I want to explain to you the game that venture capital firms are playing so that you understand the person on the other side of the table to you.
Can I ask a question?
Yes, if it's a good one.
Yeah. So, what are the like expectations of milestones, say product market fit, or what are those milestones that are expected at each part of this?
Yeah. I think that's actually a valuable thing for us to go into a little bit more detail, kind of like right now, as opposed to go for back a little bit. Okay, so what do you think that you need to have achieved? We already talked about friends and family and even like angel. What do you need to achieve to do like an angel round? So like historically, when I was first in venture in 2013, we would like do, pre-seed didn't really exist in 2013. It wasn't really, there wasn't a phrase, it wasn't labeled, that didn't really exist, right? We would do seed investing. And our seed rounds, here you said 2 to 10. The seed rounds we were doing are like 250, maybe a mil max. We actually ran a co-investing space in a place called Warney Yard in London, where we had a room like probably like double the size of this, and it just had investors in. And because we were all in the same room, we just like pushed the price up of every round that we were participating in, and they all became larger. But it was really good for the scene and for the entrepreneurs. Why do I sort of say that? Like back then in the seeds, like yeah, like honestly, like a slide deck could be enough to get the kind of like the seed, right, in 2013. Today, like you ain't getting a seed off a slide deck, right? At a seed round, you would expect it to not only have a product in the market, not only to have customers, but to have very, very strong indications of like early product market fit and early indications that you have a channel of marketing that you can acquire customers like reliably-ish kind of like on, right? Like, that's a hell of a lot more than a slide deck, you know? And so I'd sort of say there, so look here, accelerators are, you know, again, if you've got reputation and credibility as a founder and you're working on a particular problem, like an application form might be sufficient, right? If you're one of the classic Harvard, whatever, Stanford, you know, and you were at Uber and blah, 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 like, okay, great. An application might be sufficient. For a more normal person, even to get into an accelerator, you're probably gonna have to be able to like demonstrate some sort of like traction and kind of like progress. And particularly with all the AI, and we talked about how this timeline of getting down here has become faster and faster for the best companies. And again, I talked about because of the falling cost of production, the expectations of what you're meant to have achieved at each of these rounds keeps on going up and up, right? So the reality is, if even for your angel rounds, you're often going to be competing with people that have like, you know, they have vibe coded at least their products over whatever it is, right? And it's in the market and they have real customers using it, right? And so like, I would encourage you to get as much done as possible, just even for your own benefit. Like the gentleman said, like raising money is not easy, it takes time, it's not fun. If you can avoid it being a roadblock for you making progress, like it's probably the best use of your time, and you can de-risk the thing that you're working on by like proving that assumptions you have are not wrong, right? By getting a product out into the market. Everyone here should better go and sit in like Ramiro's classes that he does here, right? And be able to get a product into market and be talking to customers and validating things, right? That's going to be more useful to you than getting like, you know, some money on balance sheet in the very, very beginning. For you to raise a pre-seed, you need a product in the market. You probably need customers. Like an accelerator, like if you're at YC, what's the number one thing they tell you to focus on at YC? When you're already in YC, speak to customers, and the indication that you're doing that correctly, the top KPI they care about is week-on-week growth. What do you think week-on-week growth should be if you're like a company that's in the cohort that's doing well? 7%. Used to be 7%. That's no longer how the median company used to perform at about 7% in YC.
Recently they said 10%.
The median company these days is growing at 10% week-on-week. That's not even the, again, that's not top quartile, that's not top decile. That's the median company in YC is growing at 10% week on week, okay? So if you got 1,000 users, you now have 1,100 next week. You got 1,210 the week after, right? Like, and that is the number one thing they tell you to focus on, and that's like your arbiter of whether you're doing what's right or wrong, you know? Here at NS, we have way too much of a builder culture and not enough of a customer focused like culture, right? Like speaking to customers and like that driving everything else that you do is the most important thing. So again, that's even before your seed round, right? Like if you're growing, you've definitely already got a product and you've definitely already got customers, okay? Now what difference here again? The difference between your seed is that you're gonna have to have, again, much stronger evidence of real product market fit and evidence that there are channels that you can acquire customers through repeatably. The difference between the success of your seed or your ability to raise your Series A, by here, you not only need strong product market fit, you need economics that make sense. And what that means is that you can effectively take money and you can deploy that money reliably into marketing channels that can take a scale of capital. If the marketing channel, the only marketing channel you have is that like you turn up and like sleep on the bedroom floor of, you know, whatever it is for like an Airbnb first thing, that's fine down here, but that doesn't get you to Series A because you need to be able to spend millions of dollars having other people keep doing this stuff kind of like for you, right? And those millions of dollars have to generate enough money, you know, with enough margin in that you can recycle that cash and keep on going. So like the difference between like here, you can still sell dreams. For a Series A to go well, you have to have the economics stack up. You have to have profitable unit economics. That means that like the additional unit that you sell has a gross margin on it, right? And that gross margin covers at least typically 3x the cost of acquiring that customer. That's a LTV to CAC ratio. We do a whole session on metrics and like what's meant to be achieved at every kind of like stage. We're not going to get into it all right now. It's way too much detail, but please. Of course not. Yeah, that's no. But they're going to be indicative that the unit is profitable that they're selling, right? Right? Because you've just started a factory and maybe you're only producing 5 units and you've got like 50 people in your head office, right, to make the 5 units. But the point is you're creating processes that scale and that actually the unit, an additional unit, if you're making millions of them, you would cover the cost of the overheads, right? So this is like a P&L thing. We're not going to go through this today, but like the difference between gross costs and net costs, and what matters is your gross profit on the units that you're producing, right? So I hope that's like a little bit indicative, right? That like, you've got to build product down here, you've got to have customers kind of like here, and you have to have economics that make sense by the time that you're here, right? I think a point that's also worth exaggerating is that like, again, here, it's much more about story and narrative, right? And like here, story also helps, okay? But the reality is all the story is like a cover for the numbers. All that matters is basically a set of numbers that are being compared across every company in the world, and capital is trying to allocate themselves most effectively across that. It's all a dance for the numbers. The numbers are what matter underneath it, I am afraid. So, okay, that's a little bit of context to that. Now I want to talk about venture funds. Okay, so when you're talking about funds, you draw them with a triangle. Who works at a venture capital fund? We know this, right? What are some job titles at a venture capital fund? Associate. Okay, let's start with the ones you don't want to talk with. So, associate. Who else do we not want to talk to at the VC fund? An analyst, exactly. I mean, like, you might not want to talk to them. You're probably going to have to talk to them if you want any money, right? What comes in between partner and associate? Principal, exactly, right? And like principals are like a dotted line, They might be someone which are on partner track, and they might be really hungry, and they might really want to like get to work and do a deal that matters and build a reputation around you. Or they might be at a glass ceiling and they're just sort of sat there because everyone likes them and they're never going to make partner, right? Got to work out which one of those it is, right? Below the line is a waste of your time. Above the line are making decisions, okay?
Scouts?
Yeah, scouts are, so they're not making decisions, but they're like referring deals in. So there's two categories of that. There's venture scouts and there's venture partners. Scouts are just like much more junior forms of kind of like venture partners. Scouts typically only get what's called carry, which is we'll come into in a little bit more detail, but they get basically profit on deals that they refer. Typically they'll get like 20% of the profit the fund makes on a given deal, just that deal. Venture partners tend to be more involved, that they might even have a salary or like a retainer, and they're probably going to have a small percentage of like the entire fund, right? But again, things kind of like change, right? And then like you've got different types of partner, right? So you've got like partners, you've also then got like managing partners, general partners. So there tends to be a hierarchy there, but you're not going to have someone with the title partner unless you're at like A16Z, where like everyone at the fund is called a partner, even if they're basically an analyst, right? That's because everyone has decision-making ability, but there is definitely a hierarchy, right? Even Mark's word matters more, right, than the partner that was made partner yesterday. Okay, so this is kind of like the structure, and we'll go through an investment process after this, and like the investment process that we run through isn't even going to start until you've spoken to a partner, right? Because this is great. Okay, so you've got the partners that are in here in their little fund. Where do they get their money from? LPs. What does LP stand for?
Limited partner.
Yeah, someone works in crypto. So it stands for limited partner, right? So LPs, when you're talking about funds, are limited partners. And what do limited partners tend to look like? Like what are those? Family offices, high net worth individuals, institutions, so like pension funds, maybe private equity, like doing this like investing here and fund of funds, right? Doing this investing is a real specialism. The vast majority of investing happens in public markets, and then the private markets kind of like here. This is like venture capital is like a few percent of like total private equity, capital in private equity. It's a tiny little thing. It's a really small specialism. But there is way more capital that would be interested in getting upside of it, but they don't have the skills. So they invest, they give money to these funds, which then deploy on behalf of that, right? And it's even complex choosing partners of funds, which is where you get funds of funds. That actually, like a pension fund will not invest in one fund, they'll invest in a fund which is specialized in choosing other funds, right? So they get their money from these bigger people, right? And that's like tricky. So let's look at what a fund kind of looks like, okay? So let's say they've got $100 million. Does that look like $100 million as a fund? What do they charge those LPs for the $100 million that they have received off them? 2% management fee. So who's 2 and 20, right? So everyone heard of that phrase, 2 and 20? Like it's like across funds, like the most normal thing, likely thing that a fund of like any type in the world, not just venture funds, that's charging is 2 and 20, right? And that's a 2% management fee and then 20% carry on any profit that the fund actually kind of like makes, right? It's not quite that simple, but we're going to go through and what that kind of like looks like, okay? Now, let's say they got 100 million. What does a median venture fund return? Well, first, how long does it take for a venture fund to, like how long does a fund last? When does it get its money back? So the typical fund these days is structured as like 12 plus 1 plus 1 plus 1. Right? And what that basically means, and I might be a little bit out today, but like basically if you're investing anywhere down here and you hit a winner, it takes like a really long time to get your outcome. And actually, if you're selling earlier, you might have the opportunity of doing something called a secondary earlier so that you can sell at like your Series D or Series E. You're typically selling your winners, right? And you're getting out too early. So actually, this journey takes forever. And like, again, your ability to communicate as a founder that you're not here, like if someone was like, oh, I'm going to work for 2 years, like I've instantly shut off. I'm no longer listening to you, right? I can't even help it subconsciously, right? Like if you only expect to work for 2 years, you're wasting my time, right? So like you need to be committed for 20 years. This needs to be your life's work, right? And then there's just ticking a box. That's how long it takes, right, to do this stuff properly, right? Because everyone is they're not chasing a median result. They're chasing the companies that we all know the names of, right? You have to act like you're going to be a top of the fund performing company that returns everything, right? And we'll come into the economics of the fund in a second, okay? So it takes a long time. And like 12 plus 1 plus 1 is like, okay, 12 years, but they have these like rights in the contract to extend the fund to have longer to bring the money kind of like back. And so if they have 100 million, the fund is broken down into like a few phases, right? So how long do they take to spend 100 million?
3-4 years.
Probably a little bit quicker, kind of like normally it can take that long, but I'd say like, 2 to 3 years. And this would be called like the deployment phase. Okay, where it's actually they've got the money and now they're spending it, okay? What comes after the deployment phase? You've got like a management phase where they're no longer deploying the money, but like maybe they've been on the board seats or maybe they have to sign documents and they're just sort of sat there managing those companies. And then you have like end of life, right? And you have sort of like the exit phase where they're getting liquidity and they're trying to return capital to kind of like LPs, okay? But let's come back to this like 100 million and let's ask a question. What does like a median venture fund return? So the end of their 12 years, they've took 100 million 12 years ago. How much money are they returning now? Let's just say 10 years to make the numbers easier in a second.
5x to 10x?
Like more like 0, right? Like most venture funds are not very good at doing venture investing. So not quite the median fund, but like certainly like the kind of like the first quartile is like a 0 return. Right? They like the return like no capital, right? 5 to 10x is like easily top decile, if not even like top few percent of all performing kind of like funds in the world, right? So again, like the average fund will not do that well, right? But if we're looking at like a top quartile, right? So someone like the 75th percentile, like here that they might do something like, let's keep it simple, they might actually return 300 million. At the end of that journey, okay? So now if we work out what's going on here, okay? So we've said that they charge 2 and 20. So 2, they charge every year. So let's just simplify it. Say it's like they're doing it for, for 10 years, right? That's 20 million that they're getting on management fees. Now again, often after investment deployment phases, management fees can drop to like 1.5% or 1, whatever it is. But again, like we'll just simplify it, right? Be very normal. That's 20 million of management fees, right? So we're going to go for like fund 1, management fees, and then we're going to come to carry in a second, right? And fund 1 management fees, you said, is like 20 mil, okay? Now, what's the carry here? They have $200 million of profit. Now, again, most funds will have what's called like a hurdle rate in them, which basically means that like they have to like, for example, like beat an inflation rate, right? So you don't get the whole 200 million. Actually, you've got to beat the hurdle rate 2 over 10 years compounded. So actually maybe the profit pool's only like 150 million that they have. And then they've obviously, the kind of like the management fees are typically deducted from that as well. So you're back closer to something like 130 million. And then, yeah, okay, you then get 20% of kind of like this number kind of back here, right? So let's just call that like 25 million. So it's like they raise the fund on day one and they get 20 million. And if they perform like really well over another 10 years, they might make another 25 million, right? This is a little bit, the incentives are a little bit different, right? They're guaranteed the 20, right? So what happens to a fund when they run out of money? Raise more, right? This is great because you want to keep spending money. So even before they finish their deployment phase, they're going to start working on Fund 2. And then typically, Fund 2s are bigger than Fund 1s. So you did 100 million the first time. This time you're doing, 200 million in your fund. And again, you're still going to get management fees on that 200 million. And so again, you're guaranteed now, not 20 million, but you're guaranteed in Fund 2, you're guaranteed 40 million in management fees, which is happening in a few years' time and is guaranteed to come in, and like the carry is still like 10 years away from you getting it, right? So again, like you're just making way more money on continuing to increase the AUM. What's AUM stand for? Assets under management, right? So I think like, for example, I think A16Z probably has like 30, maybe $40 billion of assets under management that it's charging like 2% on a year. That's how they can support like a what? I think A16Z is probably like 400 or 500 people or something kind of like now, right? It's like a big firm doing a lot of things. Please.
If a family office knocks on your door, do they see you in any of this, or is that's M&A that they're looking at? They're not looking at this.
Family offices are LPs, so they would invest in a fund, and then they would give money to a fund most normally. That's what they might do.
Someone calls up and says they're from a family office and they want to invest in your company.
They're not going to do that.
It's a scammer.
Yes.
It's very unlikely. There are some family offices that do that, right, at this stage, but like it's really, really rare. It's more likely you're like talking to the child of a family that, is trying to find something to do with their life, and, maybe you get lucky, but like it's not normal. It's not normal. It's not normal. They would normally, if they're doing it professionally, they would invest in partners of VC funds that they have relationships with, and would get their exposure this way, and would not do direct investing. They don't have the skills or the setup in their office to kind of like to do this stuff.
Was that email you have a week to the people who want to sell you fundraising advisory services? 99.9% of the time. No, this will be legit, but then they'll give you advice on how to raise the value for $20,000 fixed, plus a success fee, in exchange for the business model, the financial plan, and the pitch deck. And they give down $25,000 and
Yeah, don't waste your time. Don't waste your time, guys. Okay, so we're just going to do this again. So, okay, if you return this, you get, and then you get more money carry here, right? But you're going to run out of this fund again, and you're going to be doing Fund 3. And Fund 3 is going to be even bigger, 80 million. And then actually you've got like guaranteed money that's even bigger than the original fund that you arrived, regardless of your actual delivered returns for your LPs, right? So this is like sort of the game that they're kind of like playing, right? And like, look, if they perform really well and they get the carry, like amazing, cherry on top, right? But they're really in a business of growing AUM, right? And that's how they get their kind of like guaranteed kind of like returns, right? Now, why is this important? Right. How does a fund raise their second fund when they're not going to get the returns for another 10 years? How do they raise their fund here?
Based on how far the startups have moved down the line. How it's gone from seed to bridge or Series A to B to C.
Yes, exactly, right? So people are going to go, okay, well, what's the progress of the startups that you've already invested in right now, okay? And what they're going to be looking at is something called a markup, right? And so the number one thing you need to do is deliver the partner at the investment fund a markup as soon as possible. Let's be really clear, what's a markup? The fund invests at seed, okay? And they invest at a 20 million valuation. a markup is if you raise money at any point in the future at a higher valuation, right? So if you raise your bridge at 30 or you raise your Series A at 100, that is a markup. And the partner wants you to deliver that as fast as possible because that helps them raise their next fund. Like that's just the reality of the situation. And goes back to my comment I made earlier in the session where it's like, okay, when you're talking to them, you know, you've raised your pre-seed, you're here and you're like chatting with investors about your kind of like seed, you projecting that you think you're going to raise your Series A like really fast at a much higher markup, right? You know, is nice, subtle, subconscious things that you're ticking in the back of the head where they're liking it, right? Because that's really what they need to sort of like deliver, okay? And so you can make that really easy. Like, you know, it's very reasonable for someone at seed to like be asking for a financial model, right? And like that would be maybe like a 5-year cash flow forecast, and it's going to show you're going to be like, okay, we're raising 5 million now, and we're going to raise 20 million, and actually like you in that model making it really clear. Like the number one thing that you need to show in that model, like every other cell is like white, and there's going to be one highlighted in like green with arrows pointing at it, which basically is the point that shows the markup happening in like 7 months time or something, right? Because you hit something. And I really mean it, right? Like highlight that bit so they open this spreadsheet of 10 sheets and they can see on the first sheet that you've delivered this markup for them, right? Really, really quickly. Right, what's the other thing that's sort of interesting that you need to think about from this? Right, $100 million fund. How much, what sort of size ticket are they writing, $100 million fund?
1 to 2. In general, they invest in 20 projects, something like this.
Exactly, that's the right first question. If you've got a $100 million venture fund, how many investments are they looking to make?
20, 10, 20.
Yeah, so like, look, general portfolio theory for like seed onwards is 20 kind of investments. Funds that are investing at pre-seed are typically doing a higher volume of deals, right? Like let's say minimum 30, maybe even 50. I was lucky to interview Dave McClure here. Anyone know who Dave McClure is? Oh, I love it. Different generations. When I was first investing, he was like a really big investor. He runs something called 500 Startups. Okay, the hint's in the name, right? Each fund was doing 500 investments at pre-seed, right? And did a really good job as a fund. That podcast will be out in like a month. Look out for it. He's great. Derail myself. Okay, but anyways, let's just again take a typical seed fund, investing at seed, $100 million, 20 different investments they're going to make. So how much are they investing in every deal that they do?
2 to 5 million.
Come on, I'm like setting it up for you all to make a mistake. Do the math. 100 divided by 20 equals 5, but that is not the answer, right? So if you have a $100 million fund again, and we're saying that they're doing 20 investments, it's not that simple, because actually a fund typically gets split into 2 portions, okay? Into 2 portions of, let's just say 50 mil and 50 mil. This 50 million is for doing like primary investing, okay? So they're gonna use this pot of money to invest into 20 startups. With this $50 million, they're going to use it to basically purchase their pro rata to participate in the future rounds of companies that they've already backed here, right? So say they do 20 investments here, they're going to reserve this 50 million to do the best 10 of them to do their next round and preserve the sort of like ownership, right? So what that actually means is a $100 million fund with 20 investments is going to be writing on average 2.5 million with a spread of what? What do you reckon? What's the smallest ticket they'll write?
500K.
Like 1 mil would be the smallest, and let's say 4 mil would be the largest. If they did anything else, like the model of the fund and the diversity and the risk would be a little bit too manipulated. So a little off whack. So what this means, right, is that if you're you're raising a 20 million Series A, okay, and you're speaking to an investor kind of like here that you want to sort of like to lead your round, and we'll come to that in a second. But like, if it's a $100 million fund, they're never going to participate in that, right? They just don't have enough money to do that, right? You need to be speaking to investors and make sure that they're capable, both that they have a fund that they're actively deploying in, right? And they're not just years down the line thinking of something to do. that they have money on balance sheet. Like in the first minutes of your conversation with an investor, you can clarify things like that immediately. You know, like, do you have money? Like, what's the fund site, etc. You can work that out so you know that they're actually actively investing now and you are not wasting your time. Okay.
Well, to answer correctly, mostly say, are you still deploying with this, or it's like a lot not ready right now, but they're probably raising a fund themselves.
Yeah, they are, exactly, right? But then and you might still have you might want them involved, and you can work them, and often like they want, often funds will do what's called like warehouse deals. So they might even like invest in people before they've raised the fund, and then they push them into the kind of like the fund, or they want to like go and like be talking to LPs about these like amazing investments in their pipeline. So like, just understand, what they're doing, and don't be scared to ask those questions, right? That's just like you looking like you understand what's going on, and it's like very, very fair questions, and they shouldn't not want to tell you. That should be a red flag if they won't. But yes, so again, this is so 2.5 million is going to be the average ticket that a $100 million fund is actually going to write. Now, does everyone know what pro rata rights are? That's what I just said a second ago. I like the word defend. But yeah, basically, like, so when you buy shares in a company, those shares come with rights. And one of those rights is a thing called a pro rata right. All that means is that you have almost like a right of first refusal. So you invest 5 million at 20 in your seed, and then the company's trying to raise 25 million at 100 mil pre in this Series A, okay? That's gonna be 20% dilution, right? That 25 mil at 100 mil pre, kind of like on the Series A. And so by default, if you bought the whole seed round for 20%, right? Kind of like here, you would be diluted in the Series A 20%, and your shareholding would go from 20 to 16%. Sort of like makes sense? But you have a right to actually pay in to the round that's happening and preserve your ownership. But that can be very expensive, right? For you to preserve 20% of ownership in this Series A round, you will have to buy 20% of the round, okay? Now, we just said it's a 25 mil round at 100 mil, okay? 20% of that is 5 million. You paid in 5 million here to get 20%. Here, to keep that 4%, you're having to pay 5 million again. And so again, doing pro rata very quickly becomes very expensive. So on that number, right, we said if they're going to do 10 and they're going to write 5 mil each, if that's just for the next round. Actually, a lot of the funds for their winner, they will want to participate in the B or the C. And the B round, maybe that's 100 million. And if they're trying to preserve, that's like, I mean, they've got to write a $20 million check to do that, right? So they very quickly run out of money of this, right? So that's why not everyone gets, the funds don't take their pro rata in every portfolio company. They'll often spin off like SPVs. So like when they have a winner, they'll like launch like a side car vehicle and raise from their LPs again to kind of like to try and keep on taking their pro rata when they run out of this money. But the big problem you've got here is that, again, everybody knows that the fund has an allocated amount of money to do pro rata. And if you do not get those investors to do their pro rata in you, you're not getting any of the rest of your round. Yeah? Because like, why would an outside investor think that they know better than your investor that's already been working with you for a year? If they're not going to invest more in the next round when they have money already on balance sheet to do exactly that, they're never going to think that they understand something better. Now, again, there's always exceptions, right? But broadly, like, this is the poison pills of like, if you take like, because like the A16Zs, the Sequoia and stuff, they're traditionally like, the majority of their capital is like what's called growth, right? Like growth is more like even like Series B kind of like onwards, like growth stage investing, right? And that's where you write much bigger checks, you have much bigger AUM, you get much bigger management fees, et cetera, et cetera. But these guys, as part of like wanting them to, these big brand names that right, have got into seed investing as part of like securing allocations in the best startups even earlier, right? So they have that pro rata right, and they can preempt the next rounds and they can deploy larger capital, right? But this is why they're also like poison pills. Like again, like you raise A16Z at seed out of their thing, like everyone knows they have infinite money. So if they're not trying to invest in you, you're fucked. Yeah? So this is why it's just like, it's tough, right? It's real tough. And like, yeah, we're coming to that. But so I think the final point I want to like pull out of this fun stuff here, right, is that right, $100 million fund doing investing at seed. How many partners would there be at that fund? 3 or 4, right? You might have what's called like a sole GP. General partner is someone that's like paying into the fund, and you might have a sole GP. They're not as common. They're more common than they kind of like used to be. But typically, yeah, 3 or 4, right? So if you're saying there's like 3 partners in a fund, and we said they're going to do 20 investments, right? That's like 6 or 7 investments kind of like each that they get to lead and kind of like do. And then it's, wait, we said that again, they're deploying maybe over 2 years at best. So, well, what does that mean? That means that like a partner at a fund is going to write like 3 checks a year, right? And so they might be in the business of investing like all the day. So they have to basically, they're going to see 1,000 companies this year, and you have to be in their top 3 for them to bother doing something with you, right? So that's another point to kind of extract from this, right? That's why it's just fucking, you can be good. You can hit all the milestones. You can be up there with all the KPIs, and it's still not enough, right? It's tough. It's tough. It's tough. Okay. So I think that's, any questions on like venture funds and how they work before I rub some of that off? Please.
How many winners returned on 300 million?
1, basically, right? If you looked at the, if you looked at like the distribution of like of the 20 investments that are going to come to that, let's say that like 15 of them return 0, a few of them return, you know, kind of like 1 to 3x, and then maybe they've got 1 or 2 bigger winners, right? And like one of them ideally is going to return, you know, you've got a 2.5 million kind of like ticket here, and you want to, you know, you're going to want to turn at least 300 million, like 100x, 200x, 500x in the one winner, you know, and it all comes from that one thing. And that matters. Like, let's just like do some math on that, right? Again, it's basically this one company that's going to return the 300 million, right, in sort of 10 years, okay? And again, let's say, imagine they're investing at seed and they've taken like your whole round, kind of like here, right? Now, if they've got 20% of your company here, after all these rounds here, even if they've managed to take a little bit of their pro rata, they're probably only going to have, if they're lucky, like 10% of your company kind of like IPO, right? And from that 10% of the company that they're selling, if they've managed to preserve the ownership, right, they need to generate 300 million, right? From the 2.5 million ticket that they wrote you, right? So what's that, like 130x or whatever it is, right? 120x. And what does that look like from a valuation then, right? You've got to deliver, you know, $300 million from 10%, right? So this is why the math, right? So for you to do what they need, you've got to have a $3 billion outcome, right? And that's why just like, that's the game. If you're delivering less than that, it's not relevant, you're not driving the returns, yeah? Make sense? Good question. Please, Gordon. How many parallel? I mean, they just keep on stacking. Like, you know, so again, just take these, take the classic ones you all know, right? Like, so A16Z didn't start with 50 funds, but it probably has like, I don't know, I don't want to say 50 funds now, but like, it's probably got like 30, 40, I don't know. Someone should like chat GPT it and see it, right? But they were traditionally a growth investor, and then they would keep issuing growth investing funds. And then you got like, okay, then you open up some early stage funds doing seed investing, and you keep on adding more of those on. And then maybe you do your SPVs or even later stage stuff. And like, yeah, there's a lot, you know, it can be a lot. The more traditional fund, a more traditional VC, it's really hard to raise a fund. Like, if it was easy, I would have raised my own fund as well. I haven't, because I don't know the LPs. These are very different people to the VCs that are actually doing stuff, right? I don't know LPs, I know VCs. You know, I think there's incredible deal flow here. There's loads of amazing companies and amazing founders. I would love to have a fund to invest into more, but like, it's not simple, right? So most people that set out to try and raise from LPs do not manage to close funds, you know? Most people that do a fund 1 do not get a fund 2, you know? Like, it's a hard game, you know? I give investors like a lot of a bad rap, but it's not simple doing this stuff, you know? Go.
What's the main factor for LPs to invest in a fund? Is it like personal relationships? Is it your track record or something else?
Look, it's as soon as you're doing stuff right, it's track record. Before that, like, historically, I think the data still supports that like first funds typically outperform all other funds. So if you get the right like emerging manager, the right partner at the beginning, then actually like you know, that's their best fund, their first one. Also, like A16Z, like you can't invest in them. Like, you're a family office, you want to invest in A16Z, who are you? They're like completely oversubscribed. So these funds that you know that have the reputations, like, they're oversubscribed. So you can't even invest into them if you wanted to. And so you're pushed to tier 2 funds, or maybe there's an incredible person like me. Do you want to give me some money? Come. And they're like, okay, great. I back this like potentially emerging manager to do their first fund. And then actually, again, often LPs like not quite pro rata rights, but like they have relationships. And like, again, A16Z will take funds that are strategic. Like maybe, again, a lot of LPs that we didn't actually mention that, endowments. Like university endowments are very big LPs, particularly of US kind of like funds. So like things like Stanford, I think has, I don't know, like $100 billion endowment or something like that, which they allocate a much higher proportion of capital to venture than other types of organizations, right? But that's because, again, they have this like flywheel of like, okay, they have all these amazing graduates in Stanford that are then getting funded by the capital that they have in the endowment and cycling it, right? So A16Z is being picky and is choosing LPs that can like add value, right? Not just money. Money isn't sufficient, right? It's like, well, how can you add value to A16Z? Then maybe you can get in, you know? But if you do get in early, then you've typically built a relationship and you have value. And if you pick like an emerging manager in their first fund, you're probably going to have a right to invest in their second fund, their third fund, their fourth fund, fifth fund. Everyone else is trying and there's no space, you know? So that's, I guess, like one of the incentives for you to back like an emerging manager. Please.
Can I ask you a speculative question?
Hit it.
Will the emergence of Bitcoin dry up these funds as it pressures the hurdle rate to increase? In other words, will the companies have to be even better and better and better going forward and get tougher and tougher and tougher to raise?
Yeah, like good question. So I just think the funds become denominated in Bitcoin, and that everyone doesn't just sit on their Bitcoin. That everyone puts their Bitcoin to work, just that they expect the return to be in Bitcoin as well. And everything's been repriced in Bitcoin, and you know you're still my basic view is that most of the mechanics is going to stay the same. I don't actually see Bitcoin pushing sort of like. Like the free money, whatever that phrase is, like the free money rate or whatever it is, like the minimum like risk-free return kind of rate like up very much. I think about that-ish a lot. It's an interesting question. But my personal view is that, again, like everything gets redenominated in Bitcoin, everyone's holding Bitcoin, like you're still gonna put that money to work to return more Bitcoin. Just like if you have dollars, you try and return more dollars, right? But let's park that for on here.
At the moment, if you look at the size of the VC industry in the US, how much money there is to invest, and then you look at, okay, you want to get these returns. The returns of the tech or startup space needs to be in the trillions. With like a few IPOs a year. It's not going to have this way too much money. Like 100x more money that would produce the return.
This is why you will have these investors or like, oh yeah, there's like loads of money, and then you're sat there and you can't even get $5 in your next round. You're like, stop like hitting me on the head of a stick when I'm down, right? It's really not easy. Okay, that's enough of that. What we're gonna do is we're gonna do a quick like investment process, okay? And we're going to look at like what, let's look at what it's a good job the camera doesn't capture all these people leaving out of boredom, right? God, you're not going to say that. I can cut that out, right? Yeah, exactly. I'm keeping that in, but I appreciate it. Okay, so let's actually look at the investment process from a venture, from a VC fund side, and then we'll like map on like what you do on top of that, right? So kind of like to make it work, right? So, and again, I said at the beginning, right, that what I want to do is I want to start it at the first partner. That's a P. That's a 1P at the first partner meeting. Now, these partners at the fund might be busy investing into your number one competitor. And so their analysts and their associates are going to be really happy to have like calls of you every 3 days, extracting loads of information and from you to help them do other stuff, right? So you're going to be really cautious of like analysts and associates and other people, right? What we're going to say is that the investment process really starts when a partner gets on a call with you and has like an introductory kind of like call. What happens on that first call that you're having with a partner?
It sounds like what you said, you need to get an NDA conversation.
Definitely not. No partner, no one will sign an NDA. I've never signed an NDA as part of an investment process. No. So that's a really, I'm glad you asked that, because it's a really common question and thought, right? You're like, oh, you got your precious idea and like you're really worried about revealing the information. You should be worried because anything you tell them is going to be shared with like everybody. Your deck is going to get forwarded. I get forwarded decks all the time by everybody. It's so normal. Nobody even thinks about it. And so like you should manage that. So like a big part of this process for you is actually information management, right? And actually giving too much information is bad in multiple ways. Like if you send a partner 5 files instead of 1, they might feel that they like have to read the 5 files before they speak to you again, right? Send them half a file, right? And actually more information is more reasons to say no, right? So just like information management's important anyway. If you truly have some IP, that you can't share, then you need to talk about it in the abstract and you need to leave it until DD, which will come down later, but you're gonna have to reveal it and people are not gonna. DD is covered by confidentiality in a term sheet, which is where you're protected, right? But in this beginning stuff here, no one's gonna sign anything. If you ask them to sign something, you're gonna look like an amateur. And so do not do that, okay? So what happens in that first partner meeting, okay? There's different strategies. I would encourage you to take that partner meeting in person, to try and have it as a coffee and to have it as casual and as informal as possible. You should be very prepared so that you have a deck and all the rest of it. But my personal preference, and again, this comes back to you, again, there's not like a definite way, like you should be confident in yourself and a founder in doing what makes you comfortable. But I would try and have that as a peer-to-peer, like basically you wanna be able to like take the piss out of the partner in the meeting, right? Maybe not, that's not really the goal, right? But the point is that should be the way that if you're treating them as an equal and not as some superior person, that is who they're gonna raise, that's who they're gonna give money to. If you're acting like they're God, no. So slap them around a little bit, if you can take the piss out of maybe their last investment just went to 0, something like that, right? Build rapport with an individual. This partner here is working out, do I want to work with this founder for the next 15 years? That's why it's so hard to kind of like to do this, right? Go for it.
If there's more than one co-founder, is it essential to have a one-on-one or it's fine in terms of the dynamics and how many people compared to one partner?
I think the CEO should be responsible for this and you should allocate responsibilities and no other founder should be involved until you're further down the process and you should like minimize the time that anyone else in the team has to spend on this stuff.
Sorry, but how do you even establish first contact?
Yeah, we're going to come back to that in a second. We're just going to focus on the investment process from the VC side a little bit more, right? But here, you're just going to like introduce your company, basically, right? And I think the more casual and normal that can be, as opposed to like, oh, look, here's my deck and go through the slides, the better. If you can just have a conversation where you're riffing and you're going back and he's coming on a journey with you, or she's coming on a journey with you, most likely a he, then that's a better way of doing this, right? And so after this like meeting here, and even in that meeting, the partner's probably going to go, okay, like, you're going to have some questions and he's going to like ask you to like send some follow-up information. Or if you've not gone through the deck, you're like, can you send the deck across and I'll think about it and I'll look at it, right? And actually it's really rare for a partner to bother to come on and have a second call with you unless they're actually like genuinely interested, right? There are thousands of companies they can talk to. They're not going to waste their time even on a second call, right? Now, the caveat to that is they might be investing in your competitor, and then they would really love to come and have a second call with you, right? So there's just that kind of caveat. And if they are investing in you, they probably are trying to talk to all your competitors, right? Like anyway, as part of like understanding the market better and just understanding what's going on, right? So just bear that in mind. But the next thing would be the second meeting with the first partner, okay? Where you're going to come back on, right? And this might be a few days later, this might be a couple weeks later, whatever it is, right? You're going to have like a second meeting with the partner and you're going to go into more detail on stuff, right? You're probably going to discuss the information that you've sent to them kind of like already. Now at this point, this second partner is either going to be bowing out, like for now, but if he wants to continue on this process, you going beyond the second partner meeting is like a very strong indication that like that partner is like seriously considering this as sort of like an investment, right? And actually for a fund to invest, a single partner normally can't make that investment decision themselves. Most funds actually require unanimous consent. And so we're going to come back to this in a second. But so he's already thinking that he needs to bring another partner into the process because he's got to win the support of the partnership to do a deal. So your third meeting is going to include like 2 partners, which is where like, it's the third partner with 2 partners. The third meeting with 2 partners, okay? And so they're going to bring in someone else, and that other person is going to provide another perspective. You're probably going to have asked you for some more information. You're going to have a little bit of email going back and forth, and then they're going to bring this partner in here. At this point after this, the first partner is going to be starting to work on something called an IM, or like an investment memorandum. So if you remember on these funds with these LPs and the partners, they have in between them what's called an LPA, like a limited partner agreement. And the limited partner agreement sets like the conditions at which the investors can invest. And so it's very, very normal that like a fund can't just invest in like every jurisdiction. There's going to be all these caveats in that fund of like how much the ticket sizes that they're allowed to write, in what jurisdictions, maybe even to certain industries. And so as part of that as well, there's like a due process that the funds have to follow as part of like documenting that they're running a proper investment process. And so one of those things will be an investment memorandum. And so this is basically a formal document that is used internally to basically record the thesis and the reason that they're investing in you. And that might be like a few pages to 15, 20 sort of like page like memo on your startup, the space, and why they think that they should invest with you. Now, one way you can help that partner is maybe that you've already drafted an IM, right? And you might share that kind of like with them. But they're going to start creating an investment kind of like memorandum. Now, each of these funds is going to have like typically like a weekly deal meeting, right? Well, like maybe it's Mondays at lunchtime, the partners kind of like come together and they discuss everything in the pipeline, right? And so here, anything that's happening like beyond like the second partner meeting will like be being, everything is being tracked anyway. You're being tracked. You're in their CRM and you're being tracked as soon as you've had a conversation, probably well in advance of that, right? And then they're going to be looking at the stuff that's in the hot end of that and discussing stuff. And then for anything that they are actually considering sort of investing in that deal meeting, they will probably have like a vote as to whether that they think that they should actually kind of invest. So you have like basically after the memo is going to be putting like the written kind of like argument together, and it's going to be presented at like a deal kind of like meeting. And then again, at this point, you probably need a unanimous consent of the partners in the fund to kind of like push it through. But even then, that's not the end, because actually every fund has what's called typically a investment committee. An investment committee comes after this. So the deal meeting will basically approve things to go to the investment committee. Now, what you have on the investment committee is the partners, and then you typically have like, this is like NEDs, like non-executive directors. These are like external parties that are basically there for good governance and to ensure that it's just not the partners like wiring a bunch of money to their family or whatever it is, right? Like it's like some independent people that are looking after the interests of the LPs and helping ensure that there's some due process and some impartiality to the investing, right? And then there's an investment committee. And if you're able to get the deal through the investment committee, you'll have, if you thought it was going to be this short, there's just like, it's going to keep on going. You're going to get issued what's called a term sheet. Now, a term sheet is, let's say, a 5 to 10 page legal document, which outlines like the headline terms that investor like wants to give you. Now, the partner that's leading this deal will already have had conversations with you to ensure that, you agree with all of this, right? It's like, okay, we're giving you 5 and it's going to be on something like a 20 mil, blah, 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 blah. But you're not going to go the exact thing that they're doing until they put it in writing at the term sheet, right? And it's going to put out a formal offer. Now, you already need to have lawyers engaged at this point here, because if you sign that, it is broadly, binding. It's hard to change key terms, right? If in here So term sheet, they'll put an offer out. If you sign the term sheet, you're then in exclusivity. And then due diligence starts to happen, kind of like through this. And depending on the stage of the company, this is like, they tell an analyst to like check a few files and it takes like a few days or maybe even quicker at the beginning stage, because there's nothing to DD down here, right? You don't have anything, right? There's no history, there's no financial, there's no customers. They can press some buttons on your product maybe. But if you're up here, DD can take months. right? And it might be multiple people full-time working on DD, right? And all this is loads of stuff. And then at the same time as DD is happening, you're going to be working with your lawyers on what are called the long-form documents, right? So term sheet is just a short document which sets out the headline terms, allows you to negotiate with them and sign, and then the lawyers will be working on what is much more likely to be 100 plus or hundreds of pages of documents that you will actually sign on closing day, where hopefully you've negotiated everything, everyone is okay, you sign the documents, they wire the money, and you go to sleep. No, your job starts at this point, right? Kind of like here. And then you got the money, and that's what it is. So that is the process that a fund is sort of like going to go kind of like through with you, please.
Typical time frame for that?
Yeah, so like this, again, it's like how long's a piece of string? And what you'll often hear about unhelpfully as a founder is like someone that like raised X money in like 2 days or in like 5 minutes or whatever it is, right? And that's because that founder is probably someone like me who has like worked in the industry for decades, knows everybody, so they can like get 50 first partner meetings next week, right? And that can obviously concatenate a process like dramatically, right? But like just think about it, even if it's going really fast, and like there literally are examples of partners getting to this process in like 24 hours. Right? At this like pre-seed seed stage, right? It can be done, and we'll come back to in a second about like where that tends to happen more often. If it's competitive and they're going to lose, people can move mountains. You know, people will come on a private jet and meet you in 5 hours if they think they're going to lose a round that they want to kind of like do, right? This process can very quickly end up happening in a very short period of time. But more likely for you as a founder, you're going to start having meetings, and this is going to take kind of like months, most likely. We'll come back to it in 1 second, right? In more detail, right? Because what I want to layer on is the process that you're going to run on top of this process. But we need to talk about funds quickly, briefly first. We need to distinguish two types of funds. So not all investors have balls. Most of them are what we call sheep. And that's the more technical version of this is not all investors lead deals. And what leading a deal means is that you issue term sheets, you do due diligence, and then you sit on a board for 3, 5, 10, 15 years if you've hit a winner, right? Now, that's a lot of work, right? And actually, if you can avoid doing that, that is what most investors do, okay? So I'd say lead investors probably, if you think about the whole bucket of capital that's being deployed here, investors that lead probably control almost the majority of the total capital that's being invested. Let's say 50% of the capital. But actually they are a minority of the total funds that are investing at that stage, right? So like the average fund that's doing investing at seed is not actually leading deals, right? But the majority of capital is. And why is that? It's because, again, if you're raising 5 mil at a seed, a lead investor to be like a real lead needs to be doing, say, like at least 50% of that round. Right? So if you're raising 5 mil, you're looking for a lead investor that's writing a 2.5 mil ticket, maybe a 3 or 4, or even like a 5 mil sort of like ticket, right? And that they would take the entire round as a lead investor in that point, okay? So lead investors are very different and behave differently to someone that's following on, right? If this is a lead investor process, okay? Now, if there is someone that's following on, what they're probably going to do is they're going to have meetings for you here, and they're going to get to like here, and then they're just going to stop. They're going to stop. And then, if you successfully get a term sheet over here, they will reactivate and will probably steal the investment memo that the fund that was leading wrote, kind of like for you. They'll steal all the due diligence, and they will run a quick process. Like it would still be normal, for example, for them to have like an investment committee and just some due process around how they're doing it. But they can do this very quickly, and they'll only do it if you get to this stage with another fund and you get like a lead, okay? So they'll like quickly kind of skip here. They just don't do any of this, right? If you've got like a particular, like a bit of a weird kind of follow-on investor, like maybe like a corporate investor, like someone like might not be happy that the due diligence is like sufficient And so they might want to do a little bit more of their own as part of participating. But like, yeah, follow-on investors do like way less work, okay? Way less work. And then they'll rely on the lead investor managing that investment professionally on the board and all these sort of things, right? So your lead investor is really important. A good lead investor, like that's why everyone loves like an A16Z or whatever it is, because they'll do the work and they'll like professionally manage this situation over many years. And so the follow-on investor doesn't have to. Okay, so there's two types of funds. Let's start thinking about your process. So you are here and we're going to go underneath this. You're here and we're going to speed run this and try and end on a high. Let's assume you are someone that knows nobody. And so like right now, you can't even get one partner meeting, right? So you have two challenges immediately before your first partner meeting. The first is working out how you're going to get how many of them. Let's see. Let's again, we think you're raising your seed round again, like how many first partner meetings do you have to have? Basically, how many funds do you think you need to talk to raise a seed? It's probably wiser to like plan for 100, but like aim to not have to do that many, okay? But part of the process we're talking about is like, look, if this process ends up happening in 2 hours because you're epic and you meet someone that just does it like this, amazing. But part of what we're talking about here is like, what's a process that you can execute to give yourself the best chance, right? Ooh, something like 100. You need to identify ideally like a lot of funds, like 100 funds. Now, not like random funds. You need to identify funds that like invest in your jurisdiction. Now, very quickly on that, venture capitalists basically most capital only gets deployed in the US, like into a Delaware kind of like company. I think YC invests in US, UK, Cayman, and Singapore companies. Any other company in any other jurisdiction will be asked to do a flip. Basically, there's a better word than that. Yeah, something like this. Yeah, basically, they'll invest into a US Delaware company, and that company has to basically, well, they buy. You can have like a local operating company somewhere if you want, you know. But it goes into a US company. 95% of global venture goes into, maybe 90, maybe 80% goes into a US Delaware kind of like company, right? Why was I saying that? Like 100 funds. So you need to make sure that they're funds that like invest in your sector, at your stage, and like relevant funds that you can have there. So first you got to like just like identify who they are, right? And if you want to maybe have to do 100 partner meetings, you might need to identify like 200 of these potential funds, right? And the good news is there are like lots of them. Right? There are a lot of funds that are at this kind of like stage. And most of them at the early stage are more generalist as well. There were much fewer specialized funds at the early stage, right? So you will end up being able to build like quite a big list, right? But ideally you're going to find particular partners that look like they have like an interest in your sector or whatever it is, right? So you have a genuine reason. Now you don't know any of them though, right? So now what you've got to try and do is, hopefully 10 years ago, you started working in the space and maybe you knew a whole bunch of like intermediaries, but you don't. So it's tough, right? But basically you need to find a whole bunch of people that might be able to introduce you to these partners. Now, a lot of funds will like have like an application form on their website, etc. But like it's going to go to an analyst, and you know I've got lots of friends that are analysts, and I've been berating them a bit in this meeting. But it's very unlikely that a cold email or a cold thing will end up being done. I still recommend you do like cold emails if you're in this situation. Like it can work, and there are lots and lots of examples of funds investing off cold emails. But it's going to be really, really fucking tough, right? So that's like a backup strategy is like cold emails or like filling in application forms. What you really need to do is you need to find people that can introduce you to these partners. So or a power, but you're going to be really cautious. Someone already talked about like comments about involving kind of like other people in kind of the process at kind of this stage. Like VC funds do not like there being a formal intermediary. So for that, for example, like if you're IPOing, you work with a bank, right? Like Elon Musk works with a bank every time he's raising capital, right? He's working with Goldman, JPM, whatever it is, right? Even Elon Musk, yeah? Because there's just like loads of work and loads of coordination and all the rest of it, right? And like it's just like it's wise. It's also very normal for like maybe people to be raising capital with merchant banks, with investment bankers. in these like later stage kind of like rounds, right? And they'll typically charge, anything from a couple percent up to like 5% or something from that. What you have in this sort of ecosystem here, from like particularly up to seed and Series A, is loads of brokers that want you to pay like 5% for introductions. Like, I'm sympathetic to founders working with an intermediary. Like, it's so unfair, right? Like, it's like you doing this thing for the first time in your life, and you're sat opposite this person that like professionally does this like every single fucking day, and they're telling you to not use like a professional to help you, right? But you can't use a professional to help you. Not at least, you can't bring them into meetings, you can't do any of this sort of stuff, right? You might have a friend or another founder or someone that's like coaching or helping in the background, but like you can't bring people into meetings, and you don't want to engage a formal person to help on the round at this stage. That can be such a red flag that someone will just immediately, if they learned that like there was an investment bank working on your seed round and getting 5% of the round, like that's enough for them just like not to proceed, any further, Go, Chris.
I always found that portfolio founders are the best intros, because if they're willing to take an angel ticket, they've already been verified about it.
100%, right? So questions like, how do you get introductions, right? And probably the best source of intro is a founder that has already raised money from that partner, right? That's a really, really strong kind of like signal. And then, or like partners, maybe it's a founder that's not someone that they've raised money from, but they know other partners. Like other founders is probably going to be your best thing. There might then be like other intermediary people that just like have, ecosystem actors that happen to know these people, but like founders are the place that you end up going, right? This is challenging because again, like it might take you time to build those relationships, to then to get to know you, right? And so what you're doing here is, one, you're trying to get the introductions so that you can get into these meetings. And at the same time, you're like doing like a bunch of prep, right? So you're doing your materials matter. And like, you're going to need probably potentially good materials even for those founders. Like you might like, if say you know a founder, you might ring them up for like a quick catch up, right? And you need to have like a good proposition and be able to sell them. And actually, if a founder has been backed by a company, you may not even have to ask them for that introduction, right? If you're on the money with something, right? They'll offer it, right? Because actually, if you are good, a founder will look good introducing you to a partner. Right? Because again, they're busy paying over here venture scouts and venture partners to do that. And if you'll just do that for free, like, yay, good, right? So this is part of why this like ecosystem works, is that like people want to pay it forward, and like you get a lot of things. But so you're doing two things. You're getting introductions for first meetings lined up, and you're getting your materials sort of ready. When you've got everyone stacked up and you've got enough introductions, you don't want these to like trickle in kind of like gradually, right? That's how this process ends up taking like absolutely ages, right? What you want is you want to gear up and have these introductions ready, and then you want to pull the trigger on them like all at once, right? You want to take all of these first meetings in the shortest window possible. They're all talking to each other. They all know each other. They're all syndicating the deals, right? The lead investor typically doesn't take the whole round. They're all talking to each other about the rounds that they're doing together, right? And actually, you just having everyone you're just running a process and keeping people to time in a process shows that you're on top of this in the first place. And two, it helps. Like, one of the hardest things is like the trigger for someone to give you like a term sheet and to actually make the investment decision now, because they can always wait, right? And one of the reasons, or one of the ways you get them to invest now, is they know that like someone else is probably going to do it if they don't. And like you as a founder is probably going to be like this person that like took the bet and took some risk and was first on you, right? Now you're probably still going to choose A16Z if they come in second, right? But like all other things equal, like, I like someone that takes a bet on you, right? And so if they know that you're talking to everyone and you're, and again, it's like you turn up to your first meeting like 2 minutes late and you're like, oh, so I'm really sorry. I was just talking to Mark Andreessen. I couldn't end it enough. And you're really genuinely like dropping these sort of hints. That's where it becomes more of an art and not a science. Like, you're going to like block out like a whole bunch of stuff in your calendar, so you've only able to take meetings at like 9 p.m. in the evening, and you're like, I'm sorry it was so late. I've just had like back-to-back meetings with people that are interested in this, right? Or whatever it is, right? And so like genuinely it's a bit of a game through that, but you want to bring this in together at the same time. Now what you don't want to do is find out, on a Monday morning, 2 meetings in, when you've got 50 more booked in over the week, that your messaging is off, right? Right? That'll be a bad week, right? So that's part of why doing these like introductions, speaking to these other founders, like checking yourself with friendlies before you have the real first meetings is important, right? Because you don't want to be in that situation, right? You want to be ready, and then you want to go, and you want to go at everybody at the same time and be pushing them through a funnel. Like you're going to create your own momentum that you need to get the round done. Please.
Are pitch decks enough in terms of, I guess, the initial partner or data rooms?
Like, so again, like information management is important. So like the less information you can put in the way of, the goal is not to give them information, the goal is to get money from them, right? And so that's just important. The goal is not to run this process either, just to be very clear. The goal is for you to run the smallest process and to get money kind of out of them. So be very, very clear on that. What would be typically each of these things would be, a single kind of like slide deck. And then you might immediately after this have like a sub data room that's prepared that might have depending on the velocity of the round as well, like you might be willing to share more information because of the speed that things are going, and you might have like a forecast, some like unit economics. You might have like the investment memo. You might already have that kind of like drafted. You might have like a 1-pager that's kind of like there, and just having those sort of like assets kind of like ready. Like you see more quirky things these days. Like I'm a bit of a traditionalist, but like you'll see people with like a Notion page, and they've got like an intro video for a few minutes. And like I think those things are nice. I think you should feel comfortable delivering your message and the style that you are best at, and you think represents your opportunity and what you're doing kind of like best, right?
Basically, if you bring to the meeting the investment memo, first you get a chuckle, the guy says, oh, smarty pants. But then you're controlling the narrative and you're saving him work.
100%, and that's why I recommend everyone does it. Even if it's not your core document, you've got that memo in the background. It allows you to control the narrative and save them work. I'm literally say it every time. Please.
Also, the goal for a founder is to get multiple term sheets and not just one.
100%.
What I found useful is also tiering investors and firms by rank. So A16Z would be a tier 1, a tier 4 might be Bob's Ventures, and you want to time box your raise, so let's say like 4 weeks going out to market. Like the first week you want to speak to tier 4 and get soft commits. So then when you eventually get in the room with a tier 2 or a tier 1, you've got leverage where you can say, oh, I've already pretty much got a round full with a term sheet, and then a tier 1 might just take the whole thing.
For most funds, if they're meeting you today for the first time and you've already got a round full, and you're like most funds are not going to activate, and they're just going to be like, well, sorry, it's too late, right? So you got to be cautious about that, right? You got to make sure that you're managing through, and this is important, right? As the next part, right? Because again, you're going to do these first meetings and it's in as short a time frame as possible, right? You're going to get people through second meetings. And again, you're going to have people in 2 buckets. You're going to have your lead investors and your follow-on investors. And actually, you basically need to do them simultaneously. Why? Because what you don't want to do is get a term sheet from a lead, but have nobody else committed or ready to kind of like invest. And actually, what you can use is the follow-on investors, the sheep that only get to hear, because they want to be nice, and because they don't normally get here, you can get them to like make commitments. And so like actually here, just after a couple meetings, like a follow-on investor will be like, look, I think we would be happy to give you a 500K ticket or a 1 mil ticket, And if you can get that in writing and you're confident about that, you can use that as, it's much easier for them to make a verbal commitment for that, right? On the basis you end up getting a proper lead here, than actually to give you a term sheet where they're then bound by it, right? So it's very common for people to make these commitments, like verbally on these calls, particularly their follow-on investors. And if you can sort of like collect kind of like those as well, like these sort of commitments, that will help you with momentum to getting the first term sheet. And it means that when you get the first term sheet, you actually have the capital there, right? Because if we accelerate through this to try and get through some stuff, what you don't want is a single term sheet. Because if you remember what we said is like, what was valuation? Valuation was a function of the money that you're raising, right? And we were saying like times 5 is a baseline. But how do you get a better valuation? You make it competitive, right? Obviously, if you've got one option, you're going to get very different terms to if you've got multiple options that you can batter off each other, right? Pardon me. So your work basically starts the day you get your first term sheet. Right? And you're going to get it and you're going to be like, yes, amazing. And then you're going to ring up every other investor in your pipeline. And for the lead investors, you're going to be like, just got this term sheet, right? And you're not meant to disclose like who it is and this sort of stuff, right? You're gonna be like, but I got this term sheet, right? And I'm like, it's amazing, but I'm disappointed that it wasn't you. You know, I was really hoping that we would be working together on this. Like, can you accelerate stuff at the firm? And like, can we get a term sheet out like in the next 24 hours? Like, I really want to work with you. Can you make something happen, right? Amazing. Phone down, ring the next day. Oh my God, we just got this term sheet, you know, but I really wished it was you. You know, can you make this work? Can you move faster? Can we make this happen, right? And you're gonna ring everyone and you're gonna tell them that story, right? And you're gonna have some special reason that you've got a personal connection with that partner and you want them to do the term sheet, right? Hopefully some of that's true.
Strategic investment, you need that strategic knowledge.
Ideally you're gonna be working with someone that like actually is useful, but don't expect that, right? If they can just not be harmful, that is sufficient for their job as a partner, right? As it were. But you're genuine, and at the same time, you're ringing up all the people that committed to you, right? All these people that are watching the round, the sheep following on, going like, hey, we got it. Make sure you get ready because they need to kick off their other process of whatever else that they need to do, right? And all of this is going to mean that they're all ringing each other as well in the background, they're all talking and all working out what's going on, and hopefully you're going to get a second term sheet. And then you're going to be like back to the first guys who are trying like very softly trying to like, you sometimes get aggressive exploding offers that like the term sheet is like, look, you've got 48 hours. Otherwise like we're not interested, right? Something I often do with founders is help them realize that they probably have longer than 48 hours and that you can, if they've got this far and they're giving you a term sheet that you can hold the line normally, right? And you just got to be tactical about it. But as soon as you get the second term sheet, you're again ringing up your first investor and being like, oh my God, it's amazing. Like, not amazing, but it's like, oh God, I wasn't expecting this. But like someone you must have spoken to loudly and like people have like come to us and be like, have offered us these better terms. I hoped it was going to be you, but like, can you match the terms of the new sort of like round, right? And you do that as well. And hopefully you're going to get a few term sheets. If you've got one, you can get a second one. Put it that way, right? The hardest thing is getting the first one. Once you've got that, it becomes much easier. But what's beautiful about this, right, is when we talked about this, like not valuation, but we talked about like how much money, should you raise? We put a formula out, right, for the milestones plus 6 months plus 20%, right, to give you enough padding as the minimum that you should try and raise. But if you've now got multiple term sheets from like lead investors, right, each trying to give you 4 million for the 5 million round that you wanted to raise. Like suddenly that means you've got like $12 million around the table, right? And then you've got all these sheep that also want to give you money, and that's like another 5 million. Suddenly you've got 17 million chasing this 5 million round that you want to do. And so actually what you have an opportunity here is to push the amount of money that you're raising up. And as a result of that, push your valuation up. Because valuation won't typically stay fixed. So you might be going for 5, and if you're oversubscribed, actually, you end up at 7 or 10, at 15. And I referenced the fund I used to work at, right? Like often we'd have founders that would come in and like they were happy with 500K and they walk out with 5 million because everyone wanted to come in. And you obviously can't raise 5 million at a 5 mil pre, right? When you've been happy to do 500K at a 5 mil pre, right? And so actually they end up walking out, with 5 mil on 20 mil, right? So it can happen. Rounds can escalate and get much, much bigger. So what that means again is start at your minimum number, not at your dream number. Because if you deploy the process correctly, you will have the opportunity to increase that round when you are oversubscribed, okay? There's a lot more there, but I want to actually in the last 5 minutes, answer the question of how do you raise money? Because I think there's one quick trick that I would recommend that you do.
I think it's worth taking an observation first, right? When you hear about that story of the founder raising their seed in one day, right? It's because the founder knew the partners of the fund, right? And actually they probably have a years long relationship, right? And the point is that what investors do not do is invest in dots or single crosses, right? On a graph, right? What they invest in is lights. And when you meet someone for the first time, what you're doing is you're putting a dot on the map. But investors, right, are trying to invest in these hockey stick return stock, right? We're trying to invest into trajectories. And so what you need to do over time, and why ideally you start these processes as early as possible, right? You should all start raising the round for your next company now. Like, again, and think about it in that way, genuinely, right? Like, you're not just, maybe you haven't even raised the pre-seed to the current one, but like the way that you behave on what you're doing is about building a process for your next company and how you're going to raise the pre-seed them, right? And what you're doing is you're putting dots on the map of an investor as you meet them over time. And what's going to happen is they're not going to invest in this, right? And they're not going to invest in one dot. But over time, if you start to draw this, they're going to try and invest somewhere like here, and they're going to do it, and they're going to do it themselves, right? But again, this is about building relationships, about building cadence from about. The question is like, how do you do this? Now, you can be in the game for many, many years, but again, like, how do you do this with 50 or like 100 potential partners or like stakeholders, right? The number one thing I recommend you all do is you send an update. You send a monthly update to everybody, right? And I think you should all go send the first one next month. And you should title that first update Investor Update number 27, right? For your first one, okay? Maybe not 27, right? Like if you've not even built like, the MVP, right? But like the point is that you're doing this and you're running a process, right? And then it's like whenever you meet an investor, you're going to go like, oh, I'm just going to add you to our investor updates, right? And everyone wants information, right? Because maybe they're going to invest in your competitor or whatever. They're all going to say yes. Like normally they're going to say yes, right? They want the information. And so they then receive the first one on their inbox like next week, or maybe you forward the last one and go, oh, I'm just going to opt you into this, right? And they see investor update number 7 with like undisclosed recipients, right? And they immediately know that you're running like this like really good process already of like managing these investors. Like you're already in like a superior category to everyone else that they met that day. And then they're instantly in a little bit of like FOMO, right? They're like, okay, wait, well, like he's actively managing not just me, but a whole bunch of other investors because he's been doing this for 6 months already, right? And so you're putting them in this kind of like frame of mind where now, what do you send them? You're going to send them an investor update, and it's literally going to be like, investor update. What is it? Number 27, exactly, right? And then in the this is just, and it's going to be name of your company, right? Name of your company. That's the subject line, okay? And then you're just going to do the same formula, right? You'll find the style that kind of like works for you. Oh, my Osmo's gone over there. Can you see it? I don't know. I wonder how long it's been doing that. You're going to say, okay, so up here you want to have like a 1-sentence intro, like company name, and then like 1 sentence describing what your company is, because ain't nobody going to remember, right? And you probably pivot, so many times at the beginning anyway, that it's helpful to just like anchor them with an update of like what you're kind of like doing, right? So that. And then what you want to do is like KPIs. And basically, like we said, right, with YC, what's the thing that matters most on like in the accelerator? What was that North Star metric? Weekly growth. Weekly growth, right? Like 10%, right? So what you want to do is you want to make it super easy. This is like really like 1 sentence, like half a sentence, like what your company kind of like does, right? And then you're reporting your like the KPIs, right? Now, when you don't even have a customer, again, like what matters most, and we talked about it's like basically you want to be indicating you're doing things that matter, not building things. Who gives a fuck? Customers. So like I would be like, okay, I spoke to 6 customers this week. I spoke to 10 customers this week. I'm building a wait list. Or what it like these are the things I want to indicate really, really early on, right? But as soon as you have real customers, all that matters on here is month-on-month growth. Okay. So that's just 4 weeks, right? There. Yeah. And again, you want to be doing something which is 30, 40, 50% sort of like kind of like month-on-month growth, right? So month-on-month growth, and you want to compare that versus last kind of like month. And then like the other ones matter like so much less. Like cherry pick, again, this is like 3 KPIs like maximum, because nobody is going to have time to read this stuff, all right? Make it easy. And the point is that this month-on-month growth, okay, let's just keep going. We'll go through this, right? And then you want to do like an update. And again, like you can find your own style with this, but I would do like 3 bullet points of what your update kind of is. I then do like 1 to 3 bullet points max on like what you're going to do next. Okay. And this works as like a couplet, right? Because like this month, you tell them what you're going to do this month, and then next month you report back on it, right? So what you're doing is you're drawing lines for people. Yeah. And if what you can do is like build some trust by like saying things that you actually deliver, this is great. So under promise, over deliver, over time. And then you can use that at a critical minute to really, really over promise but everyone believes you, you know, and you use it to close everybody, right? And then next year, and then you want to do an ask, and just ask to help with like one thing. It might be like, introduce me a customer, introduce me a hire. Do not say, give me money, right? Just don't put that in there, okay? That's implicit with the whole process. Do not ask the money. Do not ask for introductions to other investors, whatever it is. You got that in control. You know that shit, right? And then you thank people. And this can be as many as is sensible from the let thanks, right? So anyone that's done anything useful for you, whack them in here. And again, this is another couplet, right? It sorts itself. You thank people, that encourages people to help you. Yeah. So unless you have a better reason to do this, follow this format and put an update out here. Whatever your first draft is, cut it in half, right? You're going to all write something too long, right? I'm not going to read it. But yeah, that is the number one way to do it. That gives you an opportunity to draw the line over time for you to manage many stakeholders at once through this process. And you're going to have to do this formally as soon as you have an institution in your round anyway, right? And so you getting ahead of this process here before you have to send updates to your investors anyway on this stage here is just like a good thing to do. And again, because these investors know that you're sending it to lots of people, and because the investor knows what like good performance of a pre-seed or a seed company is, like you will shortcut that process we had on the board a second ago, and you will find that you send an email out and like a bunch of investors ask to have a catch-up call with you because you've actually reached this bit. And if you have actually got a whole bunch of partners on that email and you've got analytics and you know that they're actually kind of like reading kind of like the email, right? And people are not just reaching out to you, you haven't achieved enough. Or there's something in your communications which is like that maybe you're communicating you're a seed stage company, right? When like your performance is down here, but maybe you're actually, you know, so like if they're not reaching out, like their job is to invest, right? Like, and they want to invest ahead of everyone else and find the gems, right? So it's actually really useful in that, like, if you just do this one thing each month through time, like the process will almost like get kicked off for you. Just by doing this, and you could shortcut so much of the work. So my number one tip of how you raise money is to send a monthly update, and ideally start sending it 10 years in advance. That would be tip number 2. Okay. Any questions on that last bit? Otherwise, we're gonna wrap there for part 1. Please.
Is this think about the investors and the newsletter list, or it can be anything with named and reference related?
Yeah, anything. I mean, ideally, it would be like, you know, Mark Andreessen, thank you for looking at my model. I appreciate you doing that for me. Balaji, thank you so much for saying you want to give us all the, you know, like this would be ideal. Yeah. Thank you. And yeah.